I'm Danny Moses, and this is The Danny Moses Show. Power bill way up? Chances are it won't be coming down anytime soon. I'll explain. Plus, I'm thrilled to have one of the top investment strategists on Wall Street join the program. Cameron Dawson will be here to help us make sense of the markets. And as always, I'll give you some of my predictions in the form of Kalshi event contracts.
Over 30 years of beating Wall Street, predicting the famous Big Short. Now, he's here for you. This is The Danny Moses Show.
Welcome to the show. Every week we will talk about and help make sense of the most important and impactful events happening in the markets, and I will do my best to break it down for you in a way that both informs and entertains. That's what you can expect here on Scripps News, so let's get to it. Whether you own a home or rent an apartment, you likely deal with a monthly utility bill. While it might not be your largest expense, you might be noticing a decent increase over the past few years, even in non-peak usage times. Utility bills, when adjusted for inflation, have actually been tame for the last several years. So what has been the cause for the spike in rates? There are a few reasons. Depending on where you live, the construction and proposed construction of data centers as a result of the artificial intelligence boom require lots of power and put a strain on existing resources. Secondly, costs to upgrade existing utility infrastructure continue to increase. According to the U.S. Department of Energy, the electrical grid is approaching the end of its expected lifespan. Utilities now spend millions of dollars a year to maintain and upgrade their facilities. While utilities can spread out those costs to consumers over several years, they are also dealing with natural disasters like wildfires and storms that add stress to the system. Yes, utilities are regulated and prevented from gouging the consumer, but they have to pass on costs in order to function properly. Another shift over the last several years has been the reliance on natural gas. Recent data shows the U.S. relies on natural gas to generate more electricity than any other energy source. Gas-fired power generation accounted for 42% of U.S. utility-scale electricity, followed by nuclear at 19% and coal at 16%, with most of the remaining share coming from renewables. While natural gas provides efficient and clean energy, it's vulnerable to price shocks, like the one we are experiencing right now related to the massive storm and cold weather that is sweeping through the country. So what can we do about it? We have already seen a commitment from large technology companies such as Microsoft to pay for their fair share of power consumption and some of the costs related to grid expansion. We have also seen recent power auctions related to grid capacity that are being conducted by the government in an attempt to garner higher capital commitments in order to help utilities and regional grid operators like PJM, which alone is responsible for 13 states and over 67 million people, adapt to the increase in power demand. In conjunction with all of this, we are also seeing a resurgence in nuclear energy. Old reactors like those on 3 Mile Island are being resurrected, and new, smaller, more efficient reactors are being constructed after decades of negative growth and exile. The primary source of energy for nuclear reactors? Uranium. But these reactors take time to construct, and we are beginning to see the long-term secular play unfold, and uranium-related stocks are finally having their time in the sun. Nuclear power plants are now being included as part of these data center deals. So pay attention to what's going on in your neck of the woods. Okay, enough talking about energy. We're going to provide our own. When we come back, I will be joined by the incomparable Cameron Dawson, who will help shed some light on what's moving markets these days and how to make sense of it all.
The Danny Moses Show is sponsored by Kalshi.
Welcome back. This is the Danny Moses Show, where we simplify what's driving our economy and markets. I'm excited to welcome Cameron Dawson to the show. Cameron and I met almost 14 years ago, and I have watched in awe as Cameron has become one of the most important voices on Wall Street in a role as Chief Investment Officer at NewEdge Wealth. Cameron, thanks for being here.
Thank you so much for having me. I hope we look the same after 14 years.
You look younger. Let's start with your journey. Give us an overview of kind of how you got to where you are, and then let's talk about NewEdge Wealth and what they do.
Wonderful. Well, I've been at NewEdge. It'll be 4 years in May, and it's been an absolute whirlwind and such a thrill of a journey. I'm from Florida originally. I went to Rollins College and the Crummer Graduate School of Business, which is how we are connected. And I worked for Bank of America as an industrials analyst. So I look at all these industrial stocks rallying and think, man, I would be cool if I was still an analyst for once. I covered them during a time during the industrial recession when they weren't so much in vogue. So I've been a chief investment officer, as I mentioned, for NewEdge for the last 4 years almost, and it's been so much fun, and what fascinating markets to be able to be a part of.
It is fascinating. So I talked in the opening about electricity prices and how it's impacting the U.S. consumer. I talked last week about the debt and how that could impact everyone in the future. Let's talk about the state of the U.S. consumer and kind of what you're seeing out there.
Certainly. It's fascinating because when we look at certain surveys about the U.S. consumer, they're telling us that they feel the worst that they have felt since against the lows of the 2008 financial crisis or the lows of the pandemic when we were all shut and locked up in our homes. But when you look at spending data, consumers are continuing to spend. And one of the ways that they're able to do that is dipping more into savings. We've seen the savings rate drop to a level that we haven't seen since pre-GFC, which just suggests that consumers are doing whatever they can to keep spending, even though they're getting pinched in other places. The best way to encapsulate this is that since April, overall consumer incomes, disposable incomes on a real basis, which just means it's adjusted for inflation, are down about 0.6%, meaning they've actually declined since April. But overall consumption, meaning what they're spending money on, is up by 1.6%. So you're in this environment where consumers are trying to spend, even though they're getting pinched by things like power bills on inflation, as well as slowing wage growth, which is making that income growth slow.
Chairman Jerome Powell of the Fed had this comment about exactly what you're talking about here.
The economy overall, growth is on a solid footing, it looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
So obviously you wrote that about, but let's talk about the K-shaped economy, as we call it, and the impact. And we're going to need the consumer to keep spending, and at some point that K just stretches. Explain that, what that is, and how you see that continue.
So the K-shaped economy is effectively a way to say that there are two legs of the economy that are experiencing very different things, whether it's consumers, but it also goes the same for corporates. And the whole notion here is that the largest consumers, or the highest income consumers, are very strong, and they're driving the majority of the spending in the U.S. The stat is pretty incredible. The top 10% of income earners make up 50% of consumption in the U.S. And if you think about those high income earners, they're in a position where not only incomes are strong for them, but they also have home prices that have appreciated a lot over the last 5 years and a stock market that's been absolutely booming. So you get what's referred to as the wealth effect that also boosts consumers. And this is exactly why we are seeing this divergence between what we see within surveys, which that's effectively an equal weight. Everybody's vote counts the same. You pick up the phone to a survey respondent, or you fill out a survey online, and so the high-income consumers count the same as the lower-income consumers. You think of that consumption data, though, it's very weighted to those high-income consumers, so effectively their strength is masking some of the weakness that we're seeing under the surface. So the aggregate data looks great, but there certainly is pain when you look underneath.
When we talk about the wealth effect, the stock market going up, I think, has compounded kind of the spending. If it were to come down, you just talked about the top 10% controlling so much of the economy. What will that look like, and will it feed on itself to the downside and potentially slow the economy down as a result?
I think your operative word is feed on itself, because we've been effectively in a positive feedback loop with the economy and the stock market over the course of the last arguably 5 years, where you've seen household allocations to equities at near record highs. We can look at that. The American Association of Individual Investors publishes it, Fed Flow of Funds publishes it, and all of them show that households are effectively all in on this equity market. So as the equity market rallies, that allows them to spend more, which can allow the equity market to continue the rally. Remember, the consumer is 2/3 of the U.S. economy. So you have this positive feedback loop. So a risk that we've identified, maybe for 26 and maybe for 27, is that if you were to have a more protracted and deeper equity market correction, one that might look like a 2022, for example, that could significantly hamper overall consumption in the U.S. because that wealth effect would start to degrade, and that could create a negative feedback loop. So it's certainly something that we're watching, and one of my colleagues, Brian Nick, he's been making the joke that maybe the number one policy priority for the White House in 2026 is don't let the stock market go down.
As long as we're on the Fed here, on the topic, the independence of the Fed is obviously very important here. I think it's important. Whether you like the Federal Reserve or not, I think it's an important thing to talk about. Powell's probably, at this point, saying to himself, thank goodness I only have 2 more meetings, because he probably doesn't want to deal with this anymore. Where should rates be potentially, or how do you think the Fed's handling this? And what is the impact if someone does come in potentially and cut rates just to please somebody, when it might just spur inflation?
So there's this concept in Fed policy making that's called the neutral rate. and you might have heard it referred to as neutral or what's called R star. And it's effectively this hypothetical rate that exists somewhere in the ether that is neither stimulative to growth nor restrictive to growth. And the idea is that the Fed at this current juncture wants to be pretty close to neutral. The challenge is there's a lot of debate as to what neutral is. You have some members of the Fed suggesting that we are actually already below neutral, but then you have other members of the Fed, such as the recently appointed Myron, as well as people like Secretary Bessent, arguing that the neutral rate is lower, and that's how they're making the justification for much lower interest rates today. The question on what is the ramification of a non-independent Fed is really fascinating, because not only do you potentially have to have an entire board that will vote in line with what you want, so it's not just the chairman, there's an entire board that has to have a majority to cut rates one way or another. Then, if you have that control of the board, the next question is, do you commit a policy mistake? Now, a policy mistake by the Fed would look something like them cutting rates when they should be holding rates higher, or potentially hiking rates because of inflation or where growth is. Policy mistake on the other side is them holding rates far too low when things are booming. So first you have to have control of the Fed, then you have to have a policy mistake. The last piece of it is also important. There have to be ramifications to that policy mistake, meaning you have to see inflation start to turn higher. You have to see inflation expectations start to become unmoored, what they call unanchored. So all three of these pieces have to happen for the bond markets to really care about a lack of Fed independence, which is probably why we have seen the bond market shrug thus far at some of these threats to Fed independence.
So all roads lead to gold, right? And we're gonna play a clip here from President Trump when he was in Iowa the other day, just talking about the U.S. dollar, and I think that has a huge impact.
See the dollar's value decline more. Would that be helpful to Iowa?
No, I'd want it to be just seek its own level, which is the fair thing to do. You could have it. I could have it go up or go down like a yo-yo.
One of the consequences potentially of this type of policy is the dollar starts to get hit. And when the dollar gets hit, risk assets obviously can run. Something that's running has been gold. And I think that both dollar dropping and gold moving higher are telling us pretty much the same thing. How do you think about those things, and how important is it?
So it's fascinating with gold because the old phrase that the punishment doesn't fit the crime, I think that in the case of gold, at least right now, the degree of the rally hasn't necessarily fit the debasement. So one of the reasons why people own gold is because they're concerned about this idea of dollar debasement, meaning every dollar that you have will just go less far in the future because of inflation eroding the purchasing power of that dollar. And because gold is a fixed supply, it's this idea that it allows for some protection against that trend. But what's fascinating is that gold's parabolic rally, meaning it's pretty much gone up in a straight line, was happening at a time and started at a time when inflation expectations were pretty well contained, when you weren't seeing higher inflation readings, you're actually seeing disinflation, and the dollar was effectively sideways. So in some ways, what we have to identify is that gold has certainly been boosted by things like central bank buying. We know that because of the weaponization of the dollar, but we also have to appreciate that there is some speculative fervor that has entered the gold market over the course of the last few months as you've seen this parabolic type of rally. So it's not to say that those secular drivers for higher gold prices aren't there. It doesn't look like there's any end in sight to high deficits. It's looking like we could get further pressure for the Fed to push rates lower. All of these things are certainly bullish for gold in the long run, but appreciate the fact that when you move so far, so fast to the upside, it often doesn't take a lot to cause a correction in the other direction. And one kind of off-piste kind of expectation of what could cause gold to stumble, we think, could actually be a hot inflation print. Because if you get a hot inflation print, it effectively backs the Fed's, it puts the Feds back into a corner, because what they then would have to do is potentially consider rate hikes or keeping rates stable, not rate cuts. And so that could actually be something that could cause gold to experience volatility. Don't forget, in the high inflation period of 2022, both gold and Bitcoin were negative. So it's a really good reminder that the drivers that we think are going to help propel an asset aren't necessarily what would actually do, and appreciate the fact that you've had a very huge run already.
throw out the playbook, as they say. All right, so within the markets, we've seen a lot of rotation going on, a little bit out of tech into other areas, which I think is very positive in the sense of money staying into the stock market here. We're in the middle of earnings season here. We're probably a third of the way through, I think, at this point somewhere. We've seen some big companies report. What is it telling you so far? And as far as earnings growth is concerned, we need to have a pretty high number in 2026 to justify, I think, where the S&P 500 is trading.
Oh man, the bar is extraordinarily high. It's like pole vaulting in the Olympics as we think about how high these businesses are going to have to be able to grow earnings just to meet expectations, let alone beat expectations. So effectively, the equity market is saying that they expect not only to have a really strong economy in 2026, but effectively a productivity boom in 2026 as well. So that creates that high bar. The other thing that's happened is that since November, the beginning of November, we've had a very pro-cyclical risk-on rally. So when we think about the different pockets of the stock market, there's some pockets that do well when things are bad. Those are your defensive type of names. Then there's other pockets of the stock market that need really strong economies in order to do well. And those tend to be things like industrials, materials, energy stocks, consumer discretionary, on down the line of things that are very economically sensitive. Those stocks, in addition to things like industrial commodities, your coppers of the world, as well as cyclical currencies, so things like the Australian dollar, have all been rallying very aggressively, which suggests that traders are positioning for and expecting a global reacceleration. So we have to watch really closely for the data to start supporting that. As of right now, we feel like the Wendy's lady who's saying, "Where's the beef?" We're like, "Where's the acceleration?" But always remember, price leads data. So the price will move long before the data comes.
It feels like we're priced to perfection to a degree, but maybe they can make sense of it. All right, so the other thing that really matters here, we touched on a little bit, are longer term rates. Let's use 10-year yields, for instance. It's the be-all, end-all. It's kind of the overall report card and think of what's going on in the economy and what the U.S. government is doing. Kind of 5% was always the level that people were concerned about. It feels like it's now a little bit lower. It feels like 4.5% from a directional perspective. As we see here today, we're around 4.25%. And it really prices a lot of debt instruments that are out there. Talk about that, where you see it going, and what is kind of the red alert area, in your opinion, that would cause consternation?
Yeah, it's interesting because the red alert could actually happen with higher rates as well as lower rates because of what it tells us about the state of the economy. So if the 10-year yield were to move up much higher, it could reflect the fact that we are having potentially fiscal concerns, but higher rates also reflect higher growth and potentially higher inflation. So there is a scenario where if growth was staying very resilient, and we watch something called economic surprises, which is just how economic data is doing versus expectations. Better economic surprises could push yields higher, and that's not such a bad thing because it would be reflective of strong growth. Now, if yields are going up because of fiscal concerns, because of all the big deficits, or yields are going up because of inflation concerns, that would likely be a problem for markets. On the flip side, if yields were to fall precipitously, that could be a reflection of the fact that growth is much weaker. And so if you were to see yields, let's say, go towards 3% or a low 3 handle, a low 3% range, we would likely see that be in a scenario where growth is much weaker. And equity markets probably won't like that given the fact that they're priced for this reacceleration. So one of the things we've seen with the 10-year is that it's effectively gone sideways over the course of the last 3 years. It's just sort of oscillated around this sideways trend on the road to nowhere, like the talking heads. And so if we were to see a breakdown in one direction or another, it would tell us a lot about the underlying economy, which is why we all watch it so very closely.
Well, Cameron, the last thing I would describe you as a talking head, because you do a ton of work. You're very thoughtful in everything that you do. I can't thank you enough for coming on the Danny Moses Show. I will hope you will come back on at some
if you'll
point,
have me.
Right? So thanks so much for coming on and making sense of these markets.
Thank you for having me.
Next, I'm back with more predictions in the form of Kalshi event contracts. Hope you tuned in last week when I chose gold to outperform Bitcoin this year. There is no shortage of event contracts to choose from, and my Kalshi picks of the week are next.
After today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
The Danny Moses Show is sponsored by Kalshi.
Welcome back. It's time for my Kalshi Picks of the Week. Some topics we actually discussed in this episode. Will Trump try to fire Powell as either Fed chair or Fed governor? Try, not actually do. Read the rules when you look into it. The odds right now, I think, are 30 cents that it will be yes. So I like those odds potentially because once he steps down as chair, he's still governor until January 2028. So we'll see how that works out. Second contract I want to focus on is, will the S&P finish positive this year? We're in January. There's a long way to go here, but I'm prone to say no and pay the 32 cents that offers. So at any point during the course of the year, you would be able to trade out of it. So if we get a drawdown in the markets, I would see that going up to 40 or 50 cents. You can certainly close out your trade then. These picks are not financial advice, but if you want to learn more, go onto the Kalshi website and read the rules and use promo code Moses for a bonus when you open an account. Again, these are just my opinions. I'm not telling you what to trade or offering any investment advice. My closing thoughts when we return.
What would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
Every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well. And that is to have a separation between, to not have direct elected official control over the setting of monetary policy. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important. And the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes.
Thanks again to Cameron Dawson for coming on the show and sharing her wisdom. I'll be back with you next week for another episode of The Danny Moses Show. And my guest will be Adam Parker, founder and CEO of Trivector Research. It is newly launched Trivector Research. In the meantime, you can follow me on various social channels, including LinkedIn and X, and also on Substack, where me and my former partners, Porter Collins and Vincent Daniel, have created What Are We Doing? Contrarians at the Gate. And watch our episodes anytime on scripsnews.com/Danny Moses and on YouTube as well. So until then, I will keep an eye out on the markets for what everyone is talking about, what nobody is talking about, and what I think matters most to you. I'm Danny Moses.